So today, let's talk investing. Everybody knows it's important to invest. We are bombarded with this message, both online and offline, on a daily basis. But what we're not told very often is that we should be investing in a way that is specific to us and our own circumstances, but also what we need to do before we invest. Setting a solid foundation of knowledge and confidence before we start investing will help create a positive habit that will bring on successful investing for the rest of our lives. So what should we do? First of all, start with why. When I ask my clients, do you want to invest? The most common response I get is, yes, because I should. And that is the right answer, but there is so much more to why. We should absolutely invest so our money can be put to work, as keeping it in cash results in it losing value. Inflation will always outweigh current account interest rates, for example. But knowing what you want to invest in, what you plan to do with the income from that investment, what is its purpose? The answers to all of these questions are what will determine what you actually invest in and lead you to making a decision that you feel confident about. Too often we make investment decisions based on others' recommendations without truly understanding what we are investing in, if it's appropriate for us, and if it really fits our needs. So again, why should we invest? The main and most common reasons are accumulation of wealth, and that is using money to make money. An example of this would be saving for retirement. It is a long-term goal, as accumulating wealth through investing is best achieved through long-term investment methods. So the longer your money is invested, the more benefit you will gain from, for example, compounding, but more on compounding later. Another reason is to save for a particular expense. An example of this would be children's education fees. And again, these should be long-term goals, and that is considered over 5 years before you need that money. A third is to generate a passive income. And this is when we buy assets such as investment properties and use the rent to either subsidize our income, or even better, to reinvest elsewhere to generate more income or accumulate wealth in the long term. The next aspect we need to consider is our risk tolerance. Risk tolerance refers to the amount of loss an investor is prepared to accept while making an investment decision. It is essentially how much risk a person is willing to take on before they start to lose sleep. So several factors determine the level of risk an investor can afford to or is willing to take on. So knowing your risk tolerance level helps investors plan your entire portfolio and will drive how you invest, so it's crucial. So for example, if an individual's risk tolerance is low, they will more likely have a lot of low-risk investments than high-risk investments in their portfolio. Now, there are many quizzes online you can take to help determine your risk tolerance. But if you are starting out with investing, my recommendation would be to start with low-risk investments regardless of what you feel your risk tolerance is. Get familiar and confident with investing before you indulge in higher risk investments. And this will help you achieve a long-term positive habit and really get to feel what is your risk tolerance. So next, we need to know what asset types are available to us. And it's important to know what the most common and accessible ones are so that we can make a choice about which one works best for us. So educating ourselves on these investments will not only result in informed decisions, but will also help build that confidence level that you have in investing and what decision you have already made. The following are the most common and readily available types of investing. As stocks and shares. This is when you buy a share of a company. You in essence own part of that company. And it's common to purchase shares of an individual company you believe you will go up in value over time. This way you can buy the share at one price and sell it later at a higher price, making a gain on that investment. Shares can also provide income in the form of dividends. Exchange traded funds, or ETFs, are great ways to easily buy a variety of stocks with one purchase rather than just one stock. An exchange traded fund contains a basket of investments that could include, for example, stocks and bonds, or just one or the other. An ETF usually tracks an underlying index such as the S&P 500, but can also follow industries, commodities, or even currency. It's a great way to ensure diversification with little effort from you to achieve that diversification. So let's talk about fixed income. Fixed income investments broadly refers to those type of investments that pay out a fixed interest or a fixed dividend until its maturity date. They have a fixed term. At maturities, investors are repaid the principal amount they had invested. Government and corporate bonds are the most common types of fixed income products that are purchased. Unlike equities though, the payment of a fixed income security, they're known in advance, there is no uncertainty. Investment properties are another way of investing, and this is when we buy land, a building, or part of a building, or both, and it's held by the owner to earn rentals or capital appreciation, or both. It is different to your main residence, so remember, as your home cannot be considered an income-generated investment. It may grow in value, but it is likely only to be sold in order to use the funds to buy another home, and so should not be considered a source of income or profit. Foreign currencies. Investing in currency involves buying the currency of one country while selling the currency of another. The intention is to exchange your purchase currency for a better rate in the future. Now, there are many factors to consider before deciding to invest in foreign currency. It is the largest and most liquid market in the world, so you should know that many risks set it apart from normal equity and bond markets. Notably, the high leverage or high debt level used when investing in foreign currency that can result in high volatility or price changes and greater risk of loss. So now we've talked about the most common types of investments, let's talk about investment income that they derive. The following are the most common types of investment income. Dividends. It's paid out on a shareholding. A dividend is a sum of money paid regularly, it's typically quarterly or annually, by a company to its shareholders, and it's paid out of its profits or its reserves. So when investing for retirement, it is best to reinvest any dividends paid so that you can benefit from the effect of compounding. So in short, with compounding dividends, you earn dividends on your dividends, so not just what you initially invested. So each time you reinvest your dividends, you buy new shares on which future dividends will be paid. This snowball effect can provide significant returns on your investments, and the longer you keep your money invested, the greater that effect. Second is interest. This is when investors get paid interest on the amount they have invested in securities such as bonds or fixed-term deposits. It's usually paid at the end of the investment term. So for example, if you purchase a 12-month term deposit, you know exactly how much interest you will earn, but it will be paid when the deposit matures at the end of that 12 months. Capital gains. A capital gain refers to an increase in an asset's value. It is only realized when the asset is sold. It can apply to both equity and bond investments and also investment property. But in short, it is when we make an investment in the hope the value of that investment is more at the point when we sell it than when we purchase it. So we sell it for more than we bought it. Rental income is another source of income, and it's received by the owner of a property for allowing another person's use of that property. Royalties can be an unusual one, but it is an amount paid to a third party who is the owner of a product or a patent for the use of that product or patent. So if you invent something, issue a patent on it, then another user uses that, they must pay you a royalty. Now the next consideration is time. Time impacts two main aspects of your investment decision making, and that is whether to invest or save. So if you need the money in less than 2 to 5 years, it's probably wiser to save in a high interest bank account. If you need the money after 5 years, then it's wisest to invest the money. The next consideration is the level of risk. So the closer you get to needing the cash in the investment, the lower the risk you should apply. So for example, if you have 40 years before you plan to retire, then you have time to invest in higher risk investments because you have time to recover should your investments lose value. However, as you get close to retirement, it's important to protect the value of your investments, and so it is wise to move to a less risky investment type because as you get closer to retirement, you need the funds, therefore you should be protecting them. The next point is fees. Now it's very important to understand the fees apply to any investment that you are considering, and it can be very complicated, so invest the time. The fees you pay will come out of any benefit you receive, and so keeping them to a minimum allows you to keep more of your investment gains yourself. Fees are charged by middle people such as financial advisors or investment managers or agents on properties. It can cost money to buy certain investments such as stamp duties on properties. And there are often charges applied when certain investments are sold, such as an early redemption charges on bonds or fixed-term savings plans. So setting up your own brokerage account and placing your own investments is the most cost-effective way to invest in equities or bonds. And if you choose to use a financial advisor, ensure you understand how they're getting paid and what their fee structure is. Do you pay them, or are they getting a commission from the investment that you buy? So what other fees are in the investment contract? Do your research. So socially responsible or values-based investing is another thing to consider. Socially responsible investing expresses the investor's value judgment, of which several approaches can be used and is super personal to you. One example is when an investor avoids companies or industries that offer products or services that they don't agree with or perceive are harmful or against their values. Common examples of this are tobacco, alcohol, and defense industries. Another is considering a performance ranking in terms of how well a company performs, not only in terms of financial metrics, but also regarding social, environmental, governance, and ethical issues. And finally, there is the activist approach, and that involves the investor advocating for specific issues, such as climate change or women's rights, and buying investments related to those topics. So now you've done your homework and have a full understanding of your why, your risk tolerance, the asset types that are available and you're interested in, the type of income you expect to yield from those investments, timelines, and the fees involved. So all of this will form your investment plan, and you are now ready to start consciously and confidently investing. So what are helpful questions to ask yourself when it comes time to invest? So always bear your investment plan in mind, but the following is a good checklist to go over when you are considering a specific investment. Number 1, risk. Is it in line with your risk tolerance? Diversification. Is it going to add diversification, i.e. you don't want to have all your eggs in one basket? Now it can take time to build a diversified portfolio, but it should be part of your plan. So when considering a new investment, assess whether it provides this diversification to your portfolio. For example, do you need another share investment, or would it be wiser to seek out a bond option to balance out your portfolio and your risk? Income. Will it provide the income you need either now or in the future? Liquidity. How easy can you sell the investment? This is when time considerations are very important to understand. Fees and charges. What does it cost to get into and out of the investment? Does the level of fee allow you to still have a good return on your investment? And lastly, tax implications. So what are the tax implications of the investment, both when you purchase, hold, or sell it? Example, in most jurisdictions, investment properties carry capital gains taxes when sold and rental incomes are taxed. The next topic I feel is important to understand when first starting to invest is compound interest. We've talked about it a little earlier, but compound interest is arguably the most powerful force for generating wealth ever conceived. Warren Buffett has become one of the richest people in the world through a strategy that involved diligently and patiently compounding his investment returns over long periods of time. It is the epitome of making your money work for you while you sleep. So how does it work? Compounding interest or dividends is when you reinvest the interest or dividend you are paid on your investment. By doing this, when the next interest or dividend is paid out, you will receive a payout based on both the initial investment you made plus the amount you have reinvested. The snowball effect of compounding is proven to be the most effective way to build wealth, but bear in mind that it is a long-term strategy. It requires patience and diligence and resilience to temptation to view and use dividend or interest payments as income to be spent outside your investment portfolio. So bearing the significance of compounding in mind, the last piece of advice I have is start as soon as possible. Do your research, understand and document everything we have just discussed. Get your investment plan in place, but be conscious of analysis paralysis. If you are not yet confident, open a brokerage account and start small, with amounts you can afford and are willing to lose. Play with it in the beginning, find what works for you. The more often you invest, the more experience you will gain and the more confidence you will feel, and the quicker you will get on that road to financial freedom and wealth.